Right. Impairment. Nice, tidy chapter. Um, really looking at whether or not an asset needs to be devalued, really. Whether or not you. Because the whole point of depreciation, really, I suppose, is based on the accrual system. Not very much about devaluation. It's just the fact that the standard requires us to recognize a portion of the asset that is yielding the income. This actually specifically is asking, is this asset being faithfully represented? So that's what we mean by impairment. So the objective here is to set rules that ensure that the assets are carried at no more than their recoverable amount. And we'll see this. We'll do enough examples. But the principle is very much this question of kind of going back to IAS 2, which you know a lot about, where we recognize assets at the lower of costs. And when I say costs, this is what we're currently carrying costs via initial recognition at cost, and then we're depreciating, and we have a net book value, and it's what technically would be its net realizable value, but really we're now bringing in a third factor to discover or ultimately judge and find out what the recoverable amount is. So that's the plan. So typically, when is an asset impaired? Really, an asset is impaired if its recoverable amount, of course, is below the value currently showing the financial position. So it's currently being recognized at higher of its cost and net realizable value. So really, we want to first of all find out what that current carrying amount is. We probably might have to do one more, just do the depreciation. Recoverable amount, you can see here, is taken as the higher of the fair value less cost to sell and the value in use. So what does this mean? So typically we say, here we are, there's the cost, if you like, the carrying amount. And then we have this kind of, well, here we have the fair value less cost to sell, which is what we've always associated this from IAS 2. But we now have a third factor, which is the value in use. And we'll discuss that. Value in use is just the present value of what we think this asset is actually doing, what the asset actually generating, even though someone might look at this is more to do with value. This is more to do with just the value of the parts. So I think I gave an example. I'll give you an example in a second. But yeah, and so the higher of these two is referred to as the recoverable amount. And so I'm now really comparing the recoverable amount with my carrying amount, and whatever is, I need to make sure that it's recognized at the lower of the two. Right. So in class I gave my example of my car, an old car of mine, where I might have been, it's an S-Reg S319 FHU. It's gone into breakdown now, so this number doesn't exist anymore. So probably recognizing it technically on my balance sheet, if you like, at maybe, I don't know, £500, I don't know, whatever. This car, really, I put it into WeBuyAnyCar.com, and they offered me £25. How rude. And then, of course, my value in use I think the car would have lasted another year. And technically, it was taking me to work, bringing me back. You could have put say, a value of £100 on it in terms of value in use, and you'll be given this figure. So really, I'm interested in the higher of these two. So I'm really comparing £100, which is the higher of these two, as refers to as the recoverable amount, with the carrying amount in my current balance sheet. So this is an impairment of £400. So I'm literally debiting expense, impairment 400, and crediting my non-current asset with 400. This brings it down to 100. And that's the principle, really, that we're applying all the time. So what is value in use? Value in use is determined by estimating future inflows and cash flows to be derived from the use of the asset and its ultimate disposal. As I said, you will be given the value in use. And applying a suitable discount rate, right, is present value, really, counting. And cash flows relating to finance, of course, income tax should not be included. Here are some, again, just some basic examples of what I've just been talking about. Let's look at A. What is a well, just looking at this, here we are. I'll have carrying amount, I'll have NRV, and I'll have value in use. And let's just do it for each of them. So what do I have here? I have carrying amount of 100. Here I have net realized value of 110. and I have value in use of 120. So my recoverable amount here is the higher of the two, that is 120. So A, B, C, recoverable amount is 120. So this is 120. And of course, it's currently being recognized at 100, so that's fine. Leave it alone at 100, right? Because that is the lower of the two. So leave it at 100. Right? That's there. For B, what do I have here? For B, I have just following the same order. I have 150, I have 125, and I have 130. So again, the higher of the two is 130. It's currently being, the recoverable amount is 130, currently being recognized 150. That needs to come down by 20, doesn't it? Because it needs to be, if you like. So the recoverable amount and the the impairment loss is 20. So because it has to be held at carrying amount. So you're with me, I'm sure you are. So that's the recoverable amount, 130, and the impairment loss, of course, is 20 here. So bringing it down to 130 from 150. Yes, bringing it down from here. And then C, just looking at the same thing. C, I have here 120, then I have here 100. Oops, I have here 100. And I have a 90, so that's the net realizable value. I have value in use. Pick up the two, the highest of the two, 100, that's the recoverable amount. It's currently being recognized at 120, so this needs to come down as well by 20 to 100, right? Because it's too high. So it needs to come down by 20 to 100. Great. So yeah, so the recoverable amount here was 100, of course, for C. Recoverable amount was 100. And the impairment was 20. So that's value in use in terms of just explaining that, and that's illustration 1. How do we know if something's impaired? Really, the key point here is to do with cash flows, right? When you buy an asset, you believe at least what you expect when you buy an asset is that you will recover the cost, if nothing else. So you sell it tomorrow, you'll still get 100. That's the whole idea. But you intend to make something with it, so you believe you will get at least 100. Over the next coming years. If anything affects this potential of getting this money, for example, it really just be external issues, anything to do with pestle, you name anything, political, kills off customers, or economic, change in whatever, fall in income, change in tastes, whatever it is, social, tech, becoming obsolete, legal, there's a new legal whatever rule or legislation that says you can't sell this thing, or you have to adapt it, or the costs increase suddenly. And then, economic people, environmental people are now interested in green products, and yours still doesn't quite fit in the bill. Well, or we have a change in interest rates, of course, because interest rates are the discount factor, right? So the present value can be affected by the change in interest rates. So these are all pieces of evidence, and it might just be the car. One of the good things about audit is you're physically inspecting the asset as well, physically inspecting the asset. To make sure that the asset is fit for purpose. And so those are some of the things that we see here. We must always, again, it's a requirement to always check for impairment for goodwill, purchased goodwill, that we see. And typically, when you see an indication of impairment, we must do what we just did there: look for the recoverable amount, write it down, and record the impairment straight away to the profit or loss. But I mean, if you have some revaluation reserve, you can use that revaluation reserve against the extent of that impairment, if you like, if you wish to. And I'll show you an example in the end. So let's look at this first one. It says an entity owns a car that was involved in an accident at the year end. Barely usable, so the value in use is 1,000. So VIU is 1,000, and you can sell its parts for 3,000. So the fair value is 3 grand. So the recoverable amount is the higher of the two, which is 3 grand. Right. Now you also have the asset itself, which is held at carrying amount. And the carrying amount right now, the opening value is 8,000. And they're telling you that 8,000, and then you can have accumulated depreciation of of course, it's over 8 years, so that's 8,000 over 8 years. So that's 1,000 each year. And so the net book value is 7,000, right? So currently carrying amount is at 7, recoverable amount is at 3. So really and truly what we're saying here is that we expect to see a fall, if you like. We should recognize this at the lower of, so we need to put through a journal. We must recognize it at 3. So put through a journal of expense, debit expense 4, credit the, basically put through another 4 here. So which brings the net book value down to 3 grand. So the asset must be recognized at 3. And the impairment is 4. Great, that's TYU1. This is a good one as well. You own a property which is revalued to 500, so that's it's 500. And you had a revaluation gain, so revaluation reserve of 200,000 as a result of this movement. And then at the 31st of March, the property has a carrying amount of, so this is 500,000. The property has a carrying amount of 460,000. So that means that so far it has accumulated appreciation of 40 grand over these 2 years. I mean, all I just need to know, I'm happy, satisfied that at a cost of 500,000 and accumulated depreciation of 40, the net book value is 460. It says, but the recoverable amount of the property is estimated at only 200,000. So it means this property, let me just change my pen color, this property has fallen from 460 to 200,000. Right, that's the logic of it. So it's fallen by 260,000. So from a logic point of view, if it's fallen by 260,000, but you have 200 sitting in revaluation reserve, you can use this 200 against this 260, which means that really and truly you only truly suffer 60. But let's do the double entry. So what I need to do, first of all, is here's my impairment. So I'm going to take out the 40 out of here and put it in my impairment on the credit side of my income statement. Then I'm going to, of course, drop this from 500,000, of course, to 200,000. And then finally, I'm going to release all of this 200,000 out of here into my income statement, into the impairment expense, which means my net expense ultimately is 60 grand, right? And I'm back here. My asset is at 200,000. There is nothing in my revaluation reserve, and my accumulated depreciation is clear and clean. So I start off with this new asset that's worth 200,000. Cool, great stuff. I think that's a good place to end the first part of this class.